Welcome to your deep dive into the world of trading psychology. Today, we're exploring a talk by Alexander Elder, who has this really unique perspective because he's both a psychiatrist and, get this, a professional trader.
Yeah, it's a fascinating combo. You wouldn't think those two worlds would have much overlap, but
But they totally do.
right. And that's what makes Elder's take so interesting. He argues that both good trading and, good psychiatry are essentially about seeing reality clearly.
Okay, so it's not just about picking the right stocks or timing the market perfectly.
Nope, it goes deeper than that. It's about understanding the forces at play, both in the market and inside our own heads.
So self-awareness is a big part of
It's
this.
huge. Elder says a lot of traders focus on all those technical aspects, like the charts and indicators, but then they get into a trade and completely lose control.
Ah, I know that feeling. You get caught up in the moment and make decisions you totally regret later.
Exactly. And that's where the psychology comes in. Emotions like fear and greed start driving decisions, and that's when things can go south really fast.
So one of the first things Elder addresses is this idea of the market being a zero-sum game, right? Where for every winner, there's a loser.
Yeah, that's a common misconception. And Elder actually calls it a minus-sum game.
A minus-sum game. What does that even mean?
Well, think about it. Every time you trade, you're paying commissions, right? And then there's slippage, which is the difference between the price you expect to get and the price you actually get.
Oh, yeah, slippage. I always forget about that.
It's easy to overlook, but it can really eat into your profits, especially if you're trading frequently. So even if you're right about the market direction half the time.
Those costs can still make you a loser in the long run.
Exactly. It's like a casino taking a cut of every roulette bet.
Okay, that's a great analogy. So choosing the right broker, understanding how commissions and slippage work, that's all super important.
Absolutely crucial. Elder uses this great example of trading corn contracts to illustrate this.
Okay, tell me about it.
So you might think, oh, the commission on a single corn contract is tiny compared to the potential profit. But the key is to compare it to your margin.
Your margin. What's that?
That's the amount of money you actually put up to trade that contract. And suddenly, that small commission becomes a much bigger percentage of your risk.
Ah, I see. So it's all relative.
Right.
Right.
And then with slippage, there's even this thing called criminal slippage.
Criminal slippage? That sounds scary.
Yeah, it's essentially where some shady floor traders manipulate the system to get a better price at your expense.
Wow, I had no idea that even happened.
It's a very real thing,
Alright.
unfortunately. But anyway, the point is, successful trading isn't just about reading the markets, it's about understanding the business side of it too.
Okay, so we've talked about the market itself. Now let's dive into the individual trader. The psychology behind why people trade in the first place.
Yeah, that's a whole other can of worms.
Yes.
Elder lays out this whole spectrum of motivations from the super rational to the downright irrational.
Like what? Give me some examples.
Well, on the one hand, you have the desire for financial freedom, that dream of making a living from trading, which is a pretty powerful motivator.
Yeah, that's the dream, right? To be your own boss, work from anywhere, all that.
But then you have these other more psychological factors at play, like the thrill of the gamble. Some people just love the excitement, the adrenaline rush of it all.
Oh, yeah, it's definitely addictive. The ups and downs can be really intense.
Right. And then there's the desire to prove oneself,
Yeah.
Like, I'm smarter than the market, I can beat the system.
Yeah, there's definitely an ego element to it.
Absolutely. And Elder even talks about the dangers of playing the loser, like subconsciously sabotaging your own success
Mhm.
because of deep-seated beliefs about yourself.
Whoa, that's heavy. So you're saying, even if you have a great trading system, your own self-doubt can hold you back.
It happens all the time. That's why self-awareness is so crucial. Understanding your strengths and weaknesses, being honest about why you're really trading.
That's a good point. It's easy to get swept up in the hype and forget to do that inner work.
Right. And Elder has this great piece of advice he gives. Develop a method, manage your money, and know your weakest link yourself.
Okay, I love that. It's simple, but so profound.
Yeah, it really gets to the heart of it. You can have all the fancy tools and strategies in the world, but if you don't understand yourself, you're going to struggle.
So true. And it makes me think about how those individual motivations, when you multiply them across thousands of traders, they actually start to influence the whole market.
And that leads us to mass psychology, which is what we'll be diving into next.
Can't wait for that. Stay tuned, folks. Okay, so we just finished talking about how important self-awareness is when it comes to trading.
Absolutely. Knowing yourself, your strengths, your weaknesses, it all ties into how we react to the market too.
Right, because it's not just about our individual psychology, it's about how all those individual emotions come together to create like a collective market mood.
Exactly. And Elder compares the market to this giant, loosely organized crowd, kind of like,
Like a flock of birds all moving together.
yeah, kind of, but with a lot less coordination. The point is, the market has its own moods, its own impulses. And those moods, those impulses, they can shift on a dime.
So, how do we navigate that? How do we avoid getting swept up in that collective frenzy?
Well, Elder says the first step is understanding those crowd dynamics. Recognizing those patterns, like those historical market bubbles.
Like the tulip mania.
Exactly. Remember how tulip prices just soared based on pure speculation?
Hmm.
Everyone got caught up in the fear of missing out, the greed for quick riches. But eventually you know what happened.
Yeah, the bubble burst. And a lot of people lost a lot of money.
Right. And that's a classic example of how crowd psychology can drive markets to extremes.
So, what tools do we have to avoid getting caught up in that kind of mania?
Well, Elder talks about the importance of understanding trends and trading ranges.
Okay, so trends being like the overall direction the market is moving in.
Right. Like, is it going up, down, or just kind of sideways?
Mm.
And then trading ranges being those periods where the price is basically stuck between a certain high and low.
So, step one is figuring out what kind of market we're in.
Exactly.
Yeah.
And a lot of traders, they don't actually grasp how crucial this distinction is.
Really? It seems pretty basic.
It is. But you wouldn't believe how many people try to use the same strategies in a trending market as they do in a range-bound market.
And that doesn't work so well.
It can be disastrous
Yeah.
because the dynamics are totally different. Like in a trending market, you want to ride that wave, right? But in a range-bound market, it's more about buying at the low end of the range and selling at the high end.
So, how do we tell the difference? How do we identify those trends and ranges?
Well, that's where support and resistance levels come in. Elder describes these as like the floor and ceiling of price action.
Okay, so those are the levels where the price tends to bounce off of. I've seen those on charts.
Exactly. Think of it like a tennis match.
The tennis match.
Yeah, the ball, or the price in this case, bouncing back and forth between the players. And those players, they represent support and resistance.
I like that analogy. So, learning to identify those levels can help us anticipate where the price might reverse.
Exactly. But it's important to remember those levels. They're not just, arbitrary lines on a chart.
Right, they represent something real.
They represent the points where buyers and sellers are battling it out for control. So understanding the psychology behind those levels, that's crucial.
Okay, so we've got trends, ranges, support, and resistance. What other indicators should we be paying attention to?
Well, Elder also stresses the importance of volume and open interest.
Okay, I've heard those terms thrown around, but honestly, I'm a little fuzzy on what they actually mean.
All right, well, think of volume this way. It basically tells you how much trading activity is happening,
Hmm.
how many shares or contracts are changing hands.
So, like a busy day on the stock exchange would have high volume.
Right. And high volume often confirms a strong move, whether it's, a breakout from a range or a continuation of a trend.
So, high volume kind of adds weight to what you're seeing on the chart.
Exactly. It's like if a stock is moving up on low volume, it's kind of like, yeah, is this move for real? But if it's moving up on huge volume, it's like, okay, something's definitely happening here.
Got it. And then open interest.
So open interest is the total number of contracts that are outstanding in specifically the futures market. And rising open interest alongside rising prices, that often suggests that new money is coming into the market, fueling the move.
Ah, so it's not just about the price going up, it's about understanding why it's going up.
Right. It's like, is this just a bunch of traders shuffling paper back and forth, or are new investors actually jumping in?
And that's where open interest gives you a clue.
Exactly. And speaking of clues, Elder also talks about the element of time.
Time. What does he mean by that?
Well, markets operate on multiple time frames, right? You've got your daily charts, your weekly charts, your monthly charts.
Yeah, I've seen those.
And what looks like a trend on a daily chart might just be a tiny blip on a weekly or monthly chart.
So, like, you could think a stock is in an uptrend, but if you zoom out to the weekly chart, you see it's actually in a downtrend.
Exactly. So it's all about perspective, right?
Mhm.
And Elder says a lot of traders, they get caught up in the short-term noise, the day-to-day fluctuations, but they lose sight of the bigger picture.
So we need to be aware of what time frame we're looking at and not just get fixated on the short term.
Exactly. And Elder cautions against trying to find, like, a perfect order or cycle in the market. He says, that's a fool's errand.
Okay, no crystal ball, but people try to do that.
Oh, yeah, all the time. They get this idea that if they can just crack the code, they can predict the market perfectly.
But that's not realistic.
Nope. It's often driven by the desire for certainty and control, and it can lead to some pretty big losses.
So if we can't predict the future, what's the alternative?
Well, Elder talks about the concept of indicator seasons.
Indicator seasons, what are those?
He says, think about a farmer, right? A farmer knows there are times to plant and times to harvest.
Okay, I see where you're going with this.
And just like that, traders need to adapt their approach to the ever-changing conditions of the market.
So it's not about finding a one-size-fits-all approach. It's about understanding the current season of the market.
Exactly. It's about being flexible and adapting. And this leads us to another interesting area: psychological indicators.
We touched on this earlier, the idea of using sentiment data to kind of gauge what the crowd is thinking.
Right. And Elder argues that one of the most profitable strategies is to actually trade against the crowd at extremes.
So, like, when everyone is super bullish, it might actually be time to sell.
Exactly. When sentiment gets too one-sided, too extreme, it often signals a potential reversal. Remember the tulip mania?
Yeah, when everyone thought the price would only go up.
Right. That's when the bubble burst. So it's about recognizing those moments of extreme sentiment and being willing to take a contrarian stance.
So how do we actually measure market sentiment? What tools are out there?
There are a bunch of sentiment and consensus indicators you can track, and Elder talks about how to interpret those. But one tool he specifically highlights is the Commitment of Traders report, or the COT report.
The COT report, I've heard that term, but I'm not really sure what it is.
Well, it basically tracks the positions of different trader groups, like large speculators, hedge funds, commercial hedgers.
So, like, who's betting on what?
Exactly. And by analyzing these positions, you can kind of get a sense of who's on which side of the trade and how crowded those trades are.
So if you see, like, the smart money, those big institutional traders all piling into one side of the market, it might be a sign that a reversal is coming.
Exactly. It's all about understanding the psychology behind those moves and using that information to your advantage. Now, this all brings us to a question that I'm sure a lot of listeners are thinking about.
Okay, hit me.
What about Elder's own trading system, the triple screen?
Yes, let's talk about that. You mentioned earlier that it combines trend following and counter-trend techniques across multiple timeframes.
It does. It's a sophisticated approach, but at its core, it's really about filtering out the noise and identifying high probability trades. So the first screen, it uses weekly charts.
Weekly charts. Okay, so you're not just looking at the day-to-day movement.
Nope. You're trying to get a sense of the long-term trend, what Elder calls the tide. Is the overall market moving up, down, or sideways?
Got it. So first you establish the tide, then what?
Then the second screen uses a daily chart.
Okay, so we're zooming in a bit.
Right. And the second screen, this is where it gets interesting, because it's about identifying potential entry points to go against the tide.
Wait, what? So, like, if the overall trend is up, you're looking for opportunities to buy during a dip.
Exactly. And that's the counter trend element.
Yeah.
Elder argues that entries against the tide, when they're confirmed by other indicators, they offer the best risk-reward opportunities.
Huh. Interesting. So you're basically catching the market as it takes a breather before continuing in that long-term direction.
That's a great way to put it. And then finally, the third screen, this is where we zoom in even further, maybe using an hourly chart.
Okay, getting into the nitty-gritty now.
Right. And this third screen, it's all about fine-tuning your entry and exit points. This is where you'd use oscillators, things like the force index or stochastic.
Okay, those are getting a little technical for me.
Yeah, they are. But basically, they're momentum indicators that help you gauge, like, is the market overbought or oversold? Are we due for a pullback or a bounce?
So just to recap, you're aligning your trade with the long-term trend, entering on a counter-trend move, and then using oscillators to, like, fine-tune your timing.
Precisely. It's a robust system, and it's designed to capture profits in both trending and range-bound markets.
Now, alongside the triple screen, Elder also talks about channel trading.
Oh yeah, channel trading. That's a good one.
What is that exactly?
Well, it's a really visual way to identify trends and trading ranges. Basically, you draw lines on your chart connecting the highs and lows of price action.
So you're creating, like, a channel that the price is moving within.
Right. And these channels, they can help you visualize support and resistance, identify potential breakouts, and they can even help you fade breakouts.
We talked about fading breakouts earlier, right? It's like that contrarian approach of betting against those impulsive moves.
Exactly. So think about it. When everyone's rushing in on a breakout, driven by FOMO,
Mm.
Fear of missing out.
Yeah, that herd mentality.
Right. Well, the pros, they often anticipate a reversal, and they trade accordingly. It's a high-risk, high-reward strategy.
Sounds kind of like walking a tightrope, but potentially very lucrative.
It is, and it requires a deep understanding of, you guessed it, crowd psychology. But all of this, it brings us back to risk management.
Right, because even if you have the best trading system in the world, if you don't manage your risk properly.
You can blow up your account.
Exactly. So we've talked about the 2% rule, risking no more than 2% of your account on a single trade. What else does Elder emphasize when it comes to risk management?
Well, he goes beyond just setting stops, those automatic orders that get you out of a trade if it goes against you.
Mm.
He talks about the psychology of stop-loss placement, like how to detach yourself emotionally from those decisions.
Yeah, that makes sense, because when you're losing money, it's hard not to, hope for a reversal.
Right, but hope is not a strategy.
Exactly. So stop-loss orders, they help you take emotion out of the equation, enforce that discipline.
Right, and he talks about different types of stops. Initial stops, break-even stops, trailing stops. It's like having a toolbox of techniques.
So it's not a one-size-fits-all approach.
Nope. It's about being flexible, adapting to different market conditions, and it's about having that well-defined trading plan, a roadmap.
So you're not just reacting to the market, you're approaching it with a clear strategy.
Exactly. And Elder talks about all sorts of approaches, from trend following to counter-trend trading to even scalping.
Scalping, that's where you're in and out of trades super fast, right?
Yeah, trying to profit from those tiny price fluctuations.
Right. Sounds intense.
It is. But he offers these insights into the psychology of each approach,
Yeah.
helping you choose the one that aligns with your personality and risk tolerance.
That makes sense.
But regardless of what style you choose, he emphasizes the importance of journaling.
Journaling, like
Yeah.
keeping a diary of your trades.
Exactly. By recording your trades, your thought process, your emotional state at the time, you can start to identify patterns, learn from your mistakes.
So it's not just about analyzing the market. It's about analyzing yourself, your own behavior.
Right. It's about constant self-reflection.
Yeah.
And this brings us to, the core of Elder's philosophy.
Okay, I'm intrigued. What is it?
It's not just about mastering the technical aspects of trading. It's about developing what he calls a trader's mindset.
A trader's mindset. I like that. So what does that look like?
Well, it's about combining discipline, emotional control, a deep understanding of both individual and crowd psychology.
So all the things we've been talking about today.
Exactly. It's about treating trading like a profession, not a hobby.
This has been so insightful. We've covered so much ground, from trends and indicators to actual trading systems and risk management.
And through it all, we've seen how psychology plays this critical role in every aspect of trading.
I feel like we've just scratched the surface of Elder's wisdom, though.
You're right. There's so much more to unpack here.
So we'll dive even deeper into those final crucial elements in part 3 of this deep dive.
It's going to be good. Don't miss it.
So we've explored so much about trading psychology already.
Yeah, we've talked about everything from the market being this giant emotional crowd.
To Elder's really fascinating triple screen trading system.
But there's this one key element we haven't fully dug into yet.
Okay, what's that?
The psychology of risk management.
Right, because we touched on things like stop-loss orders, and that 2% rule. But
it goes deeper than that. It's not just about, setting a stop and forgetting about it.
so there's a whole mindset around it.
Yeah, it's about understanding that, losses, they're an inevitable part of trading.
Ugh, tell me about it. Nobody likes to lose money.
Right. But Elder argues that the key isn't to fear losses. It's to embrace them.
Embrace losses. I'm not sure I follow.
I know, it sounds kind of counterintuitive, but hear me out. It's about shifting your perspective, right? Seeing losses not as failures, but as, valuable learning opportunities.
So focusing on the process, not just the outcome. Okay, I lost on that trade, but what can I learn from it?
Exactly. And by, sticking to your trading plan, managing your risk, making rational decisions, you actually increase your odds of success over time.
So it's like that saying, you win some, you lose some, but in trading, you got to manage those losses so they don't, wipe you out.
Right. And Elder gives some really practical advice for developing that risk management mindset.
Like what?
He talks about having a business plan for your trading, just like any other business.
So treating it like a profession, not a gamble.
Exactly. This plan includes, defining your risk tolerance, setting realistic profit goals, having clear rules for entry, exit, and money management.
Okay, so structure, discipline, all those things we talked about before.
Right. And one of the biggest challenges, Elder says, is removing emotion from decision-making.
Yeah, we've talked about how fear and greed can really sabotage our trading. Like you panic and sell at the bottom, or you get greedy and hold on too long.
Exactly. And those emotions, they can cloud your judgment, make you deviate from your plan. Elders suggest techniques like meditation, mindfulness, to cultivate that emotional detachment.
So training your mind as much as learning technical analysis and all that.
Yeah. It's like, think of it like an athlete training for a big competition. They're not just working on their physical skills, they're working on their mental game too.
That's a good analogy.
And, Elder even suggests seeking professional help if needed, to address any underlying psychological issues that might be impacting your trading.
Wow, so it's a really holistic approach, taking care of your mental health as well as your trading skills.
Right. And he shares stories from his own journey,
Hmm.
being both a psychiatrist and a trader, and really emphasizes the importance of self-awareness, personal growth.
Yeah, the human element is so important. It's easy to get caught up in the numbers and forget that there's a person behind every trade.
Exactly. And he also talks about learning from other traders,
Yeah.
both successful and unsuccessful.
Like finding mentors, joining trading communities.
Yeah, because trading can be a lonely endeavor,
Yeah.
So having that network, that support system is super valuable.
Makes sense. What about staying up to date on market news and analysis, things like that?
He talks about that too. But he cautions against, getting caught up in the hype and noise.
So don't just blindly follow what everyone else is saying.
Right. It's about filtering that information overload.
Yeah.
Focusing on what truly matters for your trading decisions.
So critical thinking, independent analysis, those are key.
Absolutely. And he gives some good tips for, how to actually do that, how to discern valuable insights from all the noise.
Well, this whole deep dive has been a real eye-opener. I feel like I have this whole new understanding of what it really takes to be a successful trader.
I'm glad to hear that. And remember, it's not just about the technicals. It's about understanding yourself, the market, the crowd.
And developing that, that trader's mindset.
Yes, a trader's mindset that combines discipline, emotional control, and a deep understanding of psychology.
Trading, well, not just trading often. That's what sticks with me.
That's the key.
And you know what? I'm actually thinking about starting that trading journal we talked about, to track my progress.
I think that's a great idea. It's a really powerful tool for self-reflection, and growth.
Well, this has been a truly fascinating exploration of trading psychology with Alexander Elder.
It really has.
And remember, everyone, the journey to becoming a successful trader, it's ongoing, right? It's about continuous learning, adapting, evolving.
So true.
So stay curious, stay disciplined, and most importantly, enjoy the ride.
Happy trading.